What is net realizable value of accounts receivable? Have you ever wondered how businesses determine the actual value of their accounts receivable? Understanding the net realizable value of accounts receivable is key to grasping how companies assess what they can truly expect to collect. This value is essentially the amount of cash a company anticipates receiving from its outstanding receivables after accounting for any amounts that may not be collectible. To put it simply, net realizable value is calculated by subtracting the allowance for doubtful accounts from the total accounts receivable. The allowance for doubtful accounts is a special account that estimates the portion of receivables that might not be collected due to customer defaults or other reasons. For instance, if a company has $100,000 in accounts receivable and estimates that $10,000 may be uncollectible, the net realizable value would be $90,000. This amount represents what the company realistically expects to convert into cash. This method of valuation aligns with conservative accounting principles. By reporting accounts receivable at net realizable value, companies ensure that their assets are not overstated on financial statements. This practice is important for internal management decisions and external reporting to investors, creditors, and tax authorities. In the context of tax and accounting, both the allowance for doubtful accounts and the calculation of net realizable value are essential for compliance with generally accepted accounting principles and international financial reporting standards. These standards requiring that receivables be reported at the amount expected to be collected, rather than just the gross amount billed. This prevents companies from overstating income and assets, which could lead to inaccurate tax reporting and financial analysis. Practically, the net realizable value of accounts receivable affects the balance sheet by reducing the accounts receivable balance to a more realistic collectible amount. It also impacts the income statement through bad debt expense, which reflects the cost of estimated uncollectible accounts. This expense reduces taxable income, which can influence tax liabilities. To summarize, the net realizable value of accounts receivable is the net amount a company expects to collect from its outstanding receivables after accounting for doubtful accounts. It is calculated as follows. Net realizable value equals gross accounts receivable minus allowance for doubtful accounts. This approach ensures that financial statements present a fair and realistic view of receivables, supporting accurate accounting and tax reporting.